Robschild, no investment advice. Welcome to the show where we view financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. I say those in that order because that's the right way to think of it. Benjamin Graham's philosophy of investing just flat out makes sense. Buy stuff that seems way undervalued. It's the safest thing. It can't really keep going down forever if it seems very undervalued, and there's room for it to appreciate. That makes sense to me. Macro, there's a lot of great macro data. There's things that happen cyclically that seem to play out like clockwork most of the time. That's why that's number 2. Technicals, closer to crystal ball reading, but I still like to use them. I still like to see what's going on in the charts. And then pure crystal ball gazing, that's the point of me saying that at the beginning of each show. Today is Tuesday, February 4th, 2025. Today's episode begins with the job openings report coming out at a week 7.6 million. This was lower than what was expected and lower than the previous months. Looking over at the Fred, job openings, total non-farm payrolls. We have not payrolls, openings. I sometimes say that because it's just on my tongue. It doesn't matter. When job openings go down, that's usually during some bad things going on, like the dot-com bust or the great financial crisis, or like the COVID crash for about a month. People were, going a little crazy here. And then, since the peak of March of 2022, we've been going down and down and down with a bit of a bear market in 2022, kind of a dip, but continuing down, 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 down. I don't need to have a crystal ball to suggest that if this keeps going down, it's going to cause problems. When people don't have jobs, they're not making money. Money can't go into investments. People need to pull out of their savings. You have forced sellers of assets of all types. And that's that's just a natural part of the business cycle. And this is one of those macro pieces of data that suggests that things are slowing down. If we zoom in onto this chart here to the very tail end, you can see this is updated for the December for this report for 7.6 million. From a basic charting standpoint, looks like we're going sideways. To confirm that we're going lower, yeah, we do want to see a lower a reading lower than 7.3 million in the future. But again, this has seasonality involved with it too. So any which way you look at it, it's still looking like it's going down. Second item on the agenda, the 10-year 3-month, the 10-year minus the 3-month security. Again, every time that this inverts, usually you lend your money out for a longer period of time, you need a higher rate of return. And when it gets inverted, it means that the central bank is trying to, get people to save money and make it harder to borrow as well. And when we get to that uninverted state, when we are no longer inverted, like we've been inverted for over 2 years, and then we just uninverted recently, this is typically when, again, part of the business cycle, part of the macro part of all of this, tells us that there's a major recession, maybe even a depression coming, considering the depth and length of this previous inversion. If you've been following my show, you've already seen this chart a million times. You've probably seen it on other people's shows too. When you invert, this black line here is 0, 10-year minus 3-year treasury security. You invert below 0. What happens when you get back above 0? Recession. Again, below 0. What happens? The gray bar, the dot-com bust. Below 0. What happens? The great financial crisis. And then more recently, insanely, deeply negative. Not a little bit negative, not for a small amount of time, but for over 2 years. This makes all of these other previous dips look like child's play in comparison. But anyway you look at it, one thing that I'm keeping my eye on is to see if this even gets prolonged longer, if we're headed back into an inverted state. And I just wanted to bring up the most recent history. If I can zoom in on this, I'll just zoom in even more, I will note that we have been going sideways for a while here. Now, my expectation is that the Fed will be cutting more aggressively sooner, and that will continue to propel this further further away from zero, in a less closer to inverted state, I guess. But if we invert again, that's signaling that the economy is still too hot, and we still need to be in a position where we need to try to slow things down in order to get inflation under control. I don't believe that narrative. I don't believe that's where we're headed, but that's just me in my crystal ball. Again, I just bring it up because really since December, this is not looking like it's going up or down, and we're going sideways. And when you have something going sideways, the longer it goes sideways, the more it wants to break out, which, I'm thinking the Fed will start. There's probably a black swan coming when I look into my crystal ball, that is going to force the Fed to slam rates down. But, again, that's just me and my crystal ball. Tomorrow we have ADP employment coming out. This can help us decide, figure out ahead of time what the unemployment report might look like on Friday. It's kind of a precursor. And the biggest thing of the week really is this Friday employment report. Remember, unemployment is what triggered the SOM rule all the way back in last July. Usually when that happens, it's like the recession is here. And it's not clear it's not 100% clear that we're in a recession. Not yet. It's been almost a month since I've done a daily reminders show, but nothing's changed. So I'm still going to reference it. Watch Macro Update 11025 to hear me read through the important macro data. Some of it I've been updating here and there. I'll probably need to do a refresher as soon as I can. I don't have much time looking over the rest of this week at the very least, but I'll get it in when I can. But again, no major changes, and no major changes in the crystal ball readings nor the Robschild portfolio, which I also explain in that show. So let's get on to the charts. The S&P 500's just going sideways, notably under the 6,100 level and not really knocking on the door of the 6,100 level very obviously. And so I'm starting to sense that, this is looking more like a top than anything else. I mean, my question sort of is, what's keeping this market from going higher? I mean, there's some questions about the tariff thing, but that's not like a black swan, and that's not like, everything's falling apart yet. Like, we haven't gotten that yet. But maybe we're running out of buyers. Maybe the institutions are done unloading their billions or trillions of dollars, whatever it is, onto the poor retailer who's going to be forced to sell when this recession hits. It could be. I mean, sometimes the black swan is the stock market. Once it drops enough, people are like, I thought I had more money than I do, and I have to tighten my purse strings or whatever the phrase is. And then, it leads to lower prices, less work, everybody, everything tightening up. It's just a part of the business cycle. I think the top is in here. I think 6,100 is the top. Again, another crystal ball rating, but I think it's here. TLT, my favorite place to be, has formed a little megaphone here. So see how it breaks out of this. I will note that specifically today we had a very solid big green candle. So in the immediate short term, it appears that the bulls are in control of this market to me. The 10-year Treasury yield, this is often used as a reference as the opposite, as the upside down of TLT. When this goes down, TLT goes up, and it looks like it wants to go down. We're sort of knocking on this trend line the way that I see it on this downside. Again, with today being large red candle, opening up all the way up at 4.57 and then peaking at 4.59. And then the bears drove it down, or the bulls of bonds, I guess you could say, all the way down to 4.51 today. Yields often follow the price of crude oil. Yesterday's red candle, big red candle, engulfing quite a bit here. I mentioned it in my post updates. By the way, sometimes when I don't put up a video, I write a little note in the community tab. So subscribe if you want to make sure you get those. So yeah, oil, this is definitely not looking bullish. We're still sort of fighting in this range, but we're sort of below this previous fighting range. And so oil, it still looks pretty bearish to me from that perspective. The last notable chart is gold. Everything else, it's not really doing anything significant. We're sort of just going sideways in a lot of areas, but gold is going higher still. We went up another percentage to close the day, looks like 28.41 on gold. Yeah, I wrote in the community tab yesterday. I didn't write a post. I ended up doing a short little video. I was tired, okay? Give me a break. Yeah, I did a video. Now I remember. But gold, but I didn't show any charts. That's what I did. So this is my regular show. I'm back, guys. Gold still looking bullish and getting over this previous, double top. This could have been the top of gold, a double top of gold, but it does look like we are headed to that 3,000 mark. In market I'm not going to participate in. Again, this isn't gram worthy. This is obviously cheap, and people are obviously going to want this into the future, so I'll get a bunch of it and wait till people want it and sell it. That makes sense to me. Buying something that is enormously over all of its moving averages and chasing it higher to higher highs, it's not a game that I'm very interested in. The risk is too high for me. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.